Welcome back. The U.S. economy, gross domestic product, grew at a slower pace in the second quarter at 2.1% versus the forecast of 2.4%. The bond market has also experienced quite an unusual situation here. That in just a moment. Quarterly GDP at 2.1%. That was again versus the expectations of 2.4 following a prior report of 2.0%. Soft GDP numbers move the Federal Reserve away from the idea about raising interest rates. It's one of the key numbers that the Fed watches in addition to, the jobs numbers where they're tasked with maintaining a strong job market as well as controlling inflation, mainly CPI and PCE. Nevertheless, a soft GDP number, which is what we saw today, does move the Fed away from the idea about higher interest rates. Here we see quarterly GDP in blue overlaid with the federal funds in red. There's a definite inverse correlation. When federal funds are low, as they were in 2020, 2021, we tend to see a strong GDP. Conversely, when interest rates go up, we tend to see a weaker GDP. Higher interest rates just make it more difficult and more expensive for the economy to function. Here we see the federal funds over S&P 500, and there's the same type of inverse correlation. We could see in mid-2020, 2021, with a period of very low interest rates and a lot of COVID stimulus money as well, we saw a very strong stock market. Stocks move up in anticipation of higher or lower corporate earnings. Well, we can see now with the expectation of higher interest rates and the existence of higher interest rates, we tend to see that weigh heavily on the stock market. How the stock market has returned up to almost its recent swing highs is actually truly amazing despite the very rapid rise in interest rates. We also take into consideration the quarterly report in terms of personal savings. It's reported in billions, and the y-axis on the left-hand side, you multiply that times billions, seasonally adjusted. Now we can see historically, and we'll exclude the billions for a second. We see levels of 500 up to around 1,000. This goes into the mid 2000s. Again, remember this is during a period of very low interest rates from, well, let's say 2009 through 2015, we had almost zero or near zero interest rates, quantitative easing, a lot of Federal Reserve activity, and that caused savings to rise naturally. We saw even more savings occur and rise in 2016 through 18 under a period of very low interest rates. Of course, the COVID crisis had a very unusual effect on the savings rate because a lot of people stayed home, a lot of spending was curtailed, a lot of stimulus money was also injected into the economy. In conjunction of very low interest rates, we saw the savings rate explode. But now it has returned to the downside. We actually saw earlier this year personal savings return to levels we have not seen since those high interest rate periods of 2006, 2007. Now, that has risen to some extent, but relatively speaking, I think this is important to mention. We're still at pretty low historic levels as far as personal savings. And that poses also an additional risk if we see a significant economic turndown, a significant market turndown. There are not a lot of personal savings for the average individual to lean on. Here's quarterly GDP in blue versus a personal savings in red. We can see during those periods of time with strong economics, strong GDP, personal savings is higher. Personal savings has risen again over month over month or quarter over quarter, we should say, but they're really historically still at lows, and that does not make us feel very good considering the rather weak GDP numbers. Here's personal savings in blue versus the S&P 500. Now, the COVID crisis really had a very unusual effect in the sense that it caused very quick spikes in the market. But before that, we can see that the personal savings was doing quite well during that low interest rate environment in 2016, 2017, along with a rather strong stock market. The stock market has continued to move higher despite the personal savings really not being able to regain its footing. we have not yet returned to pre-COVID levels in terms of personal savings, despite all the stimulus and despite what we did have as very low interest rates. Remember, we had zero interest rates coming out of the COVID crisis. We saw the personal savings rise at this point, but that has gone away. It seems like we've gone through most of our savings. Now, here's household debt to GDP for the U.S. This is a ratio of debt incurred by a resident household of the U.S. economy as a percentage of the overall output. The higher the debt to GDP ratio, obviously, the more debt we're covering, or carrying, I should say. Going back to 2011, 2012, we had an 85, 90% debt to GDP ratio. That has fallen. It did spike as a result of the COVID crisis, but we've now been able to revisit new lows. This is a positive that the debt to GDP ratio has continued to decline. But we'll also take a look at, hopefully in the near to future, things like credit card debt, revolving debt, commercial bank debt, things of that nature, auto loans debt. That doesn't look so good. So that there is a little bit of a disconnect between the household debt to GDP. This, I'm guessing, I don't know, but I'm guessing this has more to do with the debt incurred by the housing market, for example. And we had very low interest rates. We're able to get in, very low interest rate loans, and perhaps that's why this is so low. Maybe under higher interest rates, this would rise. Here we see the debt to GDP ratio in dark blue, and then we have the red S&P 500. The debt to GDP ratio rose quite quite a lot, going back to late 2020. It has fallen since, but now we see as it continues to fall, the stock market has continued to rise. The debt to GDP ratio, I believe this is probably closely linked to the housing market. And because, again, such a low interest rate environment, maybe that has artificially, I should say, skewed this to the downside. Here we see the red lines, debt to GDP ratio, and the personal savings is in blue. And we can see the personal savings spiked during the COVID crisis, and the debt to GDP ratio did rise to some extent. Maybe some additional debt was taken on. That has dissipated. Unfortunately, the personal savings has also dissipated. If you're curious, in an ideal world, we'd like to see a strong personal savings number and a weak debt to GDP ratio. It was going in that direction prior to the COVID crisis, but it seems that the higher interest rates now really have kind of skewed that pattern. Now, we see something very interesting. Federal funds futures currently forecast a 90.5% chance the Federal Reserve will not raise interest rates, but rather keep them in the current range of 5.25 to 5.50. There's only a 9.5% chance the Federal Reserve will raise interest rates to 550, 575 area. This is a direct result of the GDP number, which again was soft and gives the Federal Reserve a little bit more pause for concern, a little bit more reason not to raise interest rates, and that's why the odds have shifted towards the idea about not raising interest rates. This is today's change in the Treasury market, 13 basis points to the downside in the 3-year, 12 basis points in the 5-year. It seems that the midterm maturities, 2, 3, 5, 7s, those have moved the most. And what this is telling us is the bond market is reacting to the GDP number. It's saying that there's probably the expectation is that there's less of a chance of higher interest rates further on out in the curve, meaning further on out into the future. The short-term maturities, like the 1 month, 2 month, this tells us what the bond market expects in the very near-term future. The 30-year is long-term future. This is in the next, perhaps, few years, and it's expecting a slight negative nuance, meaning less interest rates in the future, more of a negative. This is where current U.S. Treasury stand. The 2, 3, 5 are 47, 456, and 426 respectively. They have pulled back, separating themselves from the short-term maturities, which still expect in the near term higher interest rates. Why? Because Federal Reserve Chairman Powell And other speakers have said, as recently as this past weekend, the Federal Reserve is committed to their 2% inflation target mandate. We currently have inflation around 3%. That means we still have to raise interest rates in order to bring 3% down to 2% target. The GDP has affected the longer term, saying in the long term, we see a negative, but in the short term, we see higher interest rates. Interesting. 10-year bonds in purple, that's the yield, which has started to really fall. Same pattern. Long-term outlook, a little bit more on the negative side. Long-term pattern, because this is negative, it bodes well for stocks. Stocks like higher interest rates. I think this is one of the reasons why stocks are going up now. They're saying, hey, the number's not so good. The Federal Reserve may have to step away from higher interest rates just a little bit. Maybe that's better for the stock market. And then finally, this is a very interesting development. The blue line is a 10-year. The red line is a 1 year. The white area chart is the inverted bond yield curve, the inversion, I should say, which we did have a 1% inversion, meaning that the 1 year was only 1% above the 10-year. But now the 1 year came down a little. The blue line came down a lot. And now we have back to a 1.2, maybe even 1.125 inverted bond market. It means the 1 year is 125 basis points or 1.25% above the 10-year. And that means that we have more an inverted bond market. It's less likely, just to a small extent, that the 10-year is going to continue higher and overtake the 1 year, but be very wary because if the 10-year starts to really decline, we have to watch the 1 year, the red line. In the past, when we've seen the beginning of very bad stock markets, it has always been preceded. When we have an inverted bond market, this is the trigger when the 1 year crosses down below the blue line, the 10-year. That hasn't occurred yet, but we're watching for that little wiggle on the 1 year line as well. But for the time being, weak GDP, the perception is it moves us a little bit further away from the idea about high interest rates, at least in the medium term, long term outlook. And that has certainly skewed federal funds futures and the bond market. We're going to continue to watch a very full economic calendar, and we'll be sure to update you along the way with any significant changes. We hope this has been helpful. We look forward to seeing you back soon.